Have you ever stopped to think about how many times you've sold a stock just because the market was on fire with bad news? Or better yet, how many times have you bought something just because everyone was talking about it on Twitter or Reddit? If this has happened to you, don't worry, you're not alone. Many investors, especially younger ones, react like penguins in front of a predator. They all run in the same direction without even knowing why. But here's the truth. Those who make money in the long term don't follow the market noise. They control their emotions and stay focused on their own goals. In this video, I'll show you how to develop the emotional control needed to ignore the chaos and make smart decisions, even when everyone around you is panicking. Stay until the end to learn how to strengthen your investor mindset and avoid the traps that cause so many beginners to lose money. After all, success in the market doesn't depend on following the crowd, but on mastering your own mind. Now let's understand why so many investors react impulsively to the market. Imagine this scene. You're scrolling through Twitter and see a famous influencer saying that a particular stock is going to explode. You buy it excited, without doing any analysis. A few days later, the price drops, and you panic, selling everything at a loss. This cycle is common among young and intermediate investors, who are highly susceptible to sensational news and sudden market movements. The problem is that these impulsive decisions lead to unnecessary financial losses and compromise your long-term goals. Think about João, a fictional investor who lost 30% of his capital in just 1 month because he followed market trends without a clear strategy. How many times have you asked yourself, am I making the right decision, or am I just following the crowd? But what's really behind this mass selling? The answer lies in human psychology. Two major emotional factors dominate investor behavior: fear and greed. When the market rises, greed pushes us to buy overvalued assets, fearing we'll miss out. When the market falls, fear leads us to sell everything, afraid of losing even more. Additionally, there's FOMO, the fear of missing out, which makes us act without thinking. Historical examples show how these emotions create irrational cycles. Remember the dot-com bubble in the early 2000s? Millions of people invested in companies without solid fundamentals, believing prices would keep rising indefinitely. When the bubble burst, many lost everything. Another recent example was the GameStop case, where beginner investors were influenced by coordinated movements on social media without considering real risks. It's like a herd of animals running without clear direction, driven by instinct rather than reason. So how can we develop emotional control and avoid falling into these traps? The first step is to define clear goals. Before investing, ask yourself, what is my financial goal? How much time do I have to achieve it? These answers will help you stay focused on the long term, regardless of daily market fluctuations. Additionally, practice emotional detachment. A simple technique is to pause before making any decision. If you feel the urge to sell or buy, wait 24 hours and reflect on the real reason behind that choice. Another powerful strategy is to create checklists and personal rules. For example, set clear criteria for buying or selling an asset based on fundamentals, not emotions. To illustrate this, think about Maria, an investor who adopted a disciplined approach. She ignored market noise during economic crises and, over 5 years, multiplied her wealth. Her long-term mindset made all the difference. To put these strategies into practice, there are tools that can help. First, limit your exposure to external noise. Reduce the time spent on social media and avoid sensationalist news channels. Instead, focus on reliable sources and well-founded analyses. Second, adopt systematic methods like dollar-cost averaging, DCA, which involves investing small amounts regularly, regardless of market conditions. This eliminates emotional decisions and reduces the impact of volatility. Finally, consider seeking professional guidance. A mentor or financial advisor can offer objective advice and help you stay focused on your goals. Imagine the market as a stormy sea. You need to be the steady captain steering your ship, navigating the waves without losing direction. In addition to these strategies, financial education plays a crucial role. Many investors make mistakes because they don't fully understand the basic principles of the market. Reading books like The Intelligent Investor by Benjamin Graham or taking online finance courses can transform your perspective. Small changes in how you learn can lead to big results. For example, by understanding concepts like discounted cash flow or margin of safety, you become less vulnerable to market emotions. Remember, the more you know, the less fear you have. Another key point is patience. The financial market rewards those who know how to wait. Warren Buffett, one of the greatest investors of all time, built his fortune by adopting a long-term approach. He often says, "The stock market is a device for transferring wealth from the impatient to the patient." To develop patience, set realistic goals and review your progress periodically. Visualize your future objectives, like buying a house or retiring comfortably, to stay focused. Remember, time is your greatest ally, not your enemy. However, even with knowledge and patience, it's easy to fall into emotional traps. Some of them include overconfidence, anchoring, and confirmation bias. Overconfidence occurs when you excessively believe in your ability to predict the market. Anchoring happens when you fixate on an initial price, even if it no longer reflects current reality. Confirmation bias makes you seek information that confirms your beliefs while ignoring contrary data. To combat these biases, always question your motivations before making a decision. Ask yourself, am I acting based on facts or emotions? Adopting a long-term mindset is essential for success. Short-term investors often get frustrated with market volatility, while those focused on the future can see beyond daily fluctuations. Studies show that long-term investors tend to achieve consistent and sustainable returns. To maintain this mindset, visualize your future goals and remember that every decision should contribute to the bigger picture. The future belongs to those who plan today. In summary, success in the financial market doesn't depend on following the crowd, but on mastering your own mind. With emotional control, clear goals, and practical strategies, you'll be prepared to face market fluctuations and build wealth consistently. Don't let external noise distract you. Focus on the long term and adopt a resilient mindset. Remember, the market is a reflection of human emotions, but your success depends on your ability to remain calm and rational. If this video brought clarity on how to control your emotions in the market, leave a like and share it with other investors who need these tips. Subscribe to the channel for more content on finance and smart investing. Don't let market noise distract you. Focus on the long term and build your path to success. See you in the next video.